Let's talk about the oil price. Let's talk about what monetary policy is going to bring to us. You've been fairly sceptical of those that believe that the Fed is going to move early. What's the current thinking?
So my view, and not necessarily the House view, remains unchanged. No need to hike. Looser for longer globally. I think looser for longer in Japan. I think looser for longer in the US. For the US, even the House view now has changed from September to December.
Right, so we're pushing it back.
So we're pushing it back. I mean, I've said all year the Fed won't hike this year, and I don't think they're going to need to hike for at least a year. And I think, if anything, if what happens to oil prices feeds in as we expect, i.e. we start to price in deflation again, I think we might be talking about a Fed on hold or a looser Fed, perhaps early next year.
What did you make of Mark Carney's comments then? He's talking about, he's hinting at an imminent rate hike, maybe not that imminent, but he sounds a little bit more hawkish than when we last got the inflation report out.
Yeah, I mean, I think he did this and blindsided the market and himself, I think, about a year ago.
Yeah.
I suspect he'll do the same. I think central bankers need to talk up growth and inflation because they want to normalise policy. I think the reality is that I think we've all kind of figured out, and we're now figuring out in Japan, that QE is not the silver bullet, doesn't solve anything really, and in fact in some ways it's actually quite a deflationary factor because it encourages speculation and not real economy activity.
When do we wage data is going to be something that I think that all these central banks are going to be looking at. When do companies start paying their staff more? Because there's a huge gap, and it's a very long and historical story.
Yeah.
The gap between GDP per capita and GDP and wage rises, and you kind of feel that that's the missing piece right now.
I mean, I think you're bang on. I mean, I talk about 4 structural themes which are very deflationary for the world. You know, demographics, debt, technology, and then globalization.
Yeah.
I think it was Karl Marx who talked about the workers of the world being united. The workers of the world are not united.
No.
Companies can hunt the world for cheap labour. As a result, workers' pricing power is very, very weak.
Do you think that phase is coming to an end, though?
Look, I think I've been told maybe 500 times in the last 5 years that we've got really wage inflation in the US. What we tend to get is a bit of inflation in certain industries, certain sectors, amongst certain age groups, where we get a bit of a labour squeeze. But in the aggregate, when the participation rate is at 40-year lows in the US, how the hell are we going to get sustainable wage inflation? And without sustainable wage inflation in the aggregate, we don't get sustainable core CPI.
So Henry Ford, back in the day, decided that he was going to pay his workers a bit more. And what he got was an increase in productivity. Do you think that companies are going to start looking at it and going, actually, because Walmart, you look at Walmart, it's starting to do the same thing. Do you think companies are going to start figuring out that actually if they pay their staff more, they're going to get more out of their staff?
It would be a wonderful thing, right, to see real wages go up. Real wages in the US, I pick on the US because the data's the best. They're at the levels in the 1970s. The magic thing that made us forget about weak real wages was debt. That's clearly not coming back onto the household balance sheet. So I think the only way we're going to boost consumption is to boost real wages. So that would be a great thing to see. The problem, I think, for the equity market will be the questions around productivity. What does that really mean? Is it so clear-cut that it will be long-term positive? And secondly, initially at least, you're going to have to transfer some of the returns out of industry and the corporate sector away from the owners of capital to the workers. So the valuation in the equity market will probably need to take an adjustment first, right? Because I think so far all the gains from the recovery have accrued to the owners of capital through dividends and stock buybacks.
But that was the debt story, wasn't it?
Yeah, but the debt story hasn't gone away. That's the problem. So even in the US, total debt now is up 30% on where we were in 08, the debt as a percentage of GDP. So that's the underlying thing here, that actually, despite QE, despite the loose policy we've had, total indebtedness across the world, and even within the troubled economies, the troubled economies of 08, continue to go up. So that's kind of not working the way it should do.
So what's your outlook? I remember last time I spoke to you, you were expecting the DAX down pretty hard. What's the call now?
Look, I think in the very, very short term, I put out a note, I think early last week, a short-term kind of bounce was due. There was an Iran deal in the offing. There was bound to be some kind of fudge on Greece, which is what we've seen. And, of course, the Chinese authorities were going to respond with some magic solution to fix the equity market. We've kind of priced that in. I think there may be more to go. But I think, for me, August, September, October, I think look very risky from a growth perspective, from an earnings perspective, and thus from a markets perspective. And I do think that we're going to be starting to talk about the Fed as a possible cutter rather than a probable hiker within the next 6 months. I think also on that point, I think the Bank of Japan's policy decision is going to be kind of driven by what the US does.
Yeah.
For
pretty much everything is.
Yeah. But particularly the dollar-yen rate, which I think is key to, part of the thinking behind Abenomics.